Hi there. Thanks for joining us. My name is Lucas Lachance, and I'm a partner at Lane Gorman Trubit. Before we get started with today's presentation, I have a little bit of housekeeping that I need to go through, and I want to tell you a little bit about our firm. LGT does everything that you would expect out of a public accounting firm. Our assurance services group handles assurance work like compilations, reviews, and audits. Our accounting and consulting group handles project-based work, things like monthly bookkeeping services and CFO by the hour. Our tax department handles everything tax-related, including our state and local tax practice, anything federal, and of course, a couple partners head up our international tax practice. And lastly, we have our financial services group. They handle long-term financial planning as well as asset management. If you haven't done so already, please be sure to follow us on social media, particularly LinkedIn and Facebook, because all of our events are publicized well in advance and we hope to see you again in the future. I'm very excited to introduce our friends from Frost Bank today. Frost and LGT have had a lengthy relationship, and I'm particularly pleased to be able to introduce Harrison Blake and Nathan Howard. They'll be doing a presentation for you today on the balance sheet, the least understood risks. I give you our friends from Frost Bank.
Hello, I'm Harrison Blake, and I'm with Nathan Howard.
Hey, everyone.
And we are from Frost Bank. Thank you for taking the time to listen as we are excited to walk you through what we think is an important topic for helping all types of businesses of varying sizes. Balance sheet management, the least understood risks. So most organizations we interact with put most of their attention into managing their income statement, but many virtually ignore the balance sheet until the balance sheet presents large issues. Since the income statement and balance sheet are interconnected, the goal of this session is to pull the curtain back and show you how we as a bank view the balance sheet, and also talk through the common issues we see our customers run into as they grow. With a better understanding of the bank's perspective, our objective is that you will have a better idea on how to analyze and manage your financial statements more holistically, allowing you to identify and correct balance sheet issues early on and before they become a big mess. So during this lesson, we'll be going through the balance sheet from the top down, doing a refresher on the main concepts such as working capital, liquidity, leverage, which I'm sure you all know plenty about, and then spend some time digging deeper into questions such as how can I project our required working capital over future periods? Once finished, we would be happy to connect with you and hear what questions you have. So let's get started. First, we wanted to give you all a second to get to know us. So Nathan, will you take that over?
Yeah, hey, thanks, Harrison. Hope everyone is doing well today. My name is Nathan Howard. I'm a proud born and raised Texan living in the DFW region. I graduated from Texas A&M University and have been here at Frost Bank for over 3 years now. I started out in our credit analyst development program and naturally progressed into a commercial lender for Frost Bank. As a relationship manager, my role is to be the primary point of contact for our business customers and surround them with a team and financial solutions that are going to help their business grow.
Sure. And my name's Harrison Blake. I have a very similar story to Nathan here. Grew up in the Dallas region, grew up in Midlothian, Texas, went off to Texas A&M, graduated with a degree in finance there, had been with Frost ever since. Went through the same development, started as an analyst here, and developed into a relationship manager where we now help our customers. So with that, we want to go over the agenda for our time together here today. First, we are going to start by giving you an idea of who Frost Bank is and what we do. From there, we will jump into the bulk of our material and the balance sheet. We will be covering what we believe are the essentials to the balance sheet. Starting from the top down, we'll spend time speaking to liquidity and managing liquidity. Then we'll jump into trading assets, which make up liquidity, and point out a lot of good things you can be monitoring there. Then we will talk about how it all flows into working capital, and we will talk about why it is important to have a good working capital position and how we can predict how much is needed. After that, we'll cover leverage and why it can be a good and bad thing, and depending on how you monitor it. And lastly, we'll cover retained earnings and their importance in business continuity. So let's get into it. Nathan, will you start?
Yeah, so a little bit of background of who we are at Frost Bank. So we've been around for a little over 150 years now. At the end of the Civil War, T.C. Frost moved to San Antonio and partnered with his brother in a small mercantile and auction business selling goods to area ranchers. The store was located in what is now Market Square. T.C. Frost recognized an opportunity to make his customers' lives better. Noticing that wool prices dipped sharply at shearing time, he began storing his customers' wool and loaning his own capital against it. When prices corrected, his customers received top dollar for their wool and repaid their loans. This relationship enabled the settlers to get much needed supplies for frontier survival. Through word of mouth, his services to settlers grew quickly, and over time, what started out in the corner of a general store in San Antonio, Texas, grew and prospered through 2 world wars, the Great Depression, the 1980s, and financial crisis. The true measure of a financial institution is how well it handles changing times. The ability to successfully navigate changing times is evident with the Frost expansion across Texas. Even while our company has changed, our philosophy has never and will never change.
So that's a little bit about the history of Frost, but what are the main tenets of what we believe here? At Frost, we truly believe that our culture is our value proposition, and this is proven by 3 small but significant statements that are woven into our culture. First and foremost, one being that everyone is significant. Whether you have a small account or a big account, you're going to be treated like a person and not a number. We're going to be there for all of our customers through the ups and downs, and we're always here to try and find a way to help you and your business. 2, we offer a square deal, excellence at a fair price. We feel that in any relationship, which we are a relationship bank, there's push and pull. We believe a square deal means that both parties help benefit each other. We love to partner with our customers, get to know their companies, and provide them great customer service. So we offer a good and competitive cost that reflects that. And lastly, we're a safe, sound place to do business for our employees and our customers. Nathan touched on this quite a bit, but the reason we've been around so long is because we're a safe and sound place. We're prudent, and that has helped us through all of the major crises over the years. And so this personal approach is a product of our heritage. And staying true to our founding values has not only served our customers well, it's the reason our company has grown steadily into a top 60 bank here in the US. And as Nathan mentioned, managing about $45 billion in assets. So we've gone through who we are and what we believe. And so this last slide just covers all that we offer. Some people are surprised to learn that Frost offers a full complement of banking services, investment and insurance products, and services that any business, nonprofit, family, or individual needs. You can read through these, but Nathan and I are both on the banking side, where our top priority is working with our customers to help meet their banking needs, whether it's lending or treasury management. A few good examples of what we really specialize in the Dallas market is real estate financing, implementing working capital lines of credit, which we'll get into a little bit more here, and equipment financing. We do work hand in hand with our investments and insurance groups as well, and can help you get connected wherever your need is. And so with that, let's jump into our balance sheet material. First and foremost, let's talk about liquidity. This is at the top of the balance sheet and is absolutely vital to managing your day-to-day operations, as well as the health of your company. Every day, companies have countless transactions going in and out of their operating accounts, affecting their liquidity, and managing the overall level of liquidity will be crucial to make sure the company is able to perform critical functions, such as paying their employees, meeting expenses, and repaying investors or banks. So because of that importance, liquidity has to be managed properly in the long term as well as the short term. But let's do a quick refresher on liquidity. How are we defining liquidity today? So liquidity refers to the ease with which an asset or security can be converted into ready cash. A few quick points on that. First, a liquid asset is an asset that can easily be converted into cash within a short amount of time. The top 3 liquid assets we'll be talking about today and how to manage them are usually the most important. You have cash, accounts receivable, and inventory, but more to that in a moment. Second, liquid assets tend to have liquid markets with high levels of demand and security. A good example of this is investments. In terms of investments, equities are among the most liquid of the assets. But even within the class of equities, individual investments differ in terms of liquidity based on the market and the availability. Third, businesses record liquid assets in the current assets portion of their balance sheet. Pretty self-explanatory, but these are the assets of a company that are expected to be sold or used as a result of standard business operations over the next year. And lastly, we have the main formulas used for calculating the liquidity of the company. Their overall goal is to measure the company's ability to meet obligations. First, you have the current ratio, and second, you have the quick ratio. They're essentially the same, just the quick ratio is a little bit more strict. The current ratio measures a company's ability to pay short-term and long-term obligations. It does that by measuring current assets against current liabilities. Every time we're helping our prospects or customers, we're taking a look at their current ratio over multiple periods and checking it against the industry metrics for that size of company. This helps give us and our customers a good grip of how they're managing their liquidity compared to their peers. So ultimately, with that quick and that current ratio, we believe the best way to manage your liquidity is by having a deeper understanding of your trading assets, primarily accounts receivable, inventory, and the cycles that govern that. So because these end up affecting cash balances, over the next few slides, we'll be covering the types of questions we ask to gain a better understanding of your assets. Hopefully, this will provide some immediate insight into how a bank looks at trading assets when evaluating a lending opportunity. So first up of the trading assets, we have accounts receivable, and there are a lot of aspects of AR that are important to understand. So first and most important, we have customer concentrations. To understand the strength of the overall accounts receivable, we need to know how concentrated that AR is. For this, we will use a top 5 AR model, which looks at the top customers from a company's AR aging. At the bank, we consider anything above 20 to 25% of total receivables to any one customer a significant concentration. When concentrations arise, it's crucial understanding the company's relationship with the customer. Do they have contracts in place? If so, what are the terms? Other questions include, considering this concentration, what are the other mitigates that make us feel comfortable with this? Or is there a good secondary repayment option if converting trading assets becomes a problem due to concentrations? In our world, we have seen otherwise strong companies be hurt when one of their top concentrations leaves for a competitor. While this customer's relationship may have been a large concentration for our customer, the company was only a small supplier to the larger company. So this made them shifting business to a competitor easier, which in turn hurt our customer. Second, we have foreign accounts. As you can imagine, there's more risk related to AR coming from a company outside of the US. So when evaluating a company, we have to assign a proper amount to those accounts receivable compared to domestic accounts. In general, the larger the business, the safer these international receivables are, because it can just be hard for a smaller to medium-sized business to be able to invoice and collect properly when the receivables are out of the country. So next, past due accounts. Once AR passes a certain amount of days, it needs to be understood what the company is going to be doing to try and collect those specific accounts. If this is a significant balance, that can make things more worrisome. For that reason, in general, we will consider any receivable 60 days from due date or 90 days from invoice date as past due. This can be adjusted shorter or longer depending on the company's specific business. As industries change, what's allowable changes as well. And so as someone running a business, it goes a long way explaining to your bank beforehand when you believe a large customer is going to be late on payments and getting in front of that. Fourth, we have the number of accounts and average invoices. This is one of the more sneaky ones we've seen, just because you can have a company that has a lot of AR, which is a good thing, but there are cases when it cannot be a good thing, right? So the opposite of having concentrations would be having smaller AR concentrations to a large number of customers. When a business has numerous accounts with small balances, it can become a more difficult process to collect from those customers. For example, we've had customers here in the past that have great AR balances and are cash flowing that have major difficulty whenever a major supplier pulls out from the relationship. And so their focus goes to collecting their AR, but because they had over 20,000 accounts and each account was under $1,000, right? So that makes the average receivable about $50. They focused on collecting, and at the end of the day, it was just something that was near impossible to do, right? And so the company saw some negative effects because of that. And so moving on, we have intercompany receivables and receivables from officers and employees. These are important because as companies grow bigger and begin having subsidiaries and affiliated companies, they're likely to start having intercompany receivables. Because of this, it is very important to have a strong understanding on how intercompany AR and AP work within a company's network. At this level of complexity, things that will help make the bank more comfortable are explaining these relationships early. Audited financial statements always help, right? And providing supporting documentation that reconciles these accounts. So, breaking out AR trade from AR intercompany will really help your banker out. And lastly, companies' invoicing procedures and frequency of invoicing. Same with some prior points. These help paint a picture of the AR aging. Businesses should think through their invoicing process at different stages of their business, and especially as they grow. What works as a smaller company may not suffice as a bigger company, and vice versa. And so if you start seeing those days start creeping up, it might be time to invest into a invoice system that helps you grow or helps you scale as you grow your company. So let's look at inventory. So inventory is the other side of the coin, right? Once you convert inventory, it becomes AR. So it's important to understand both sides of this transaction. So on the slide, I have just a few examples here I'm going to cover, although there's endless, amount of examples you can get when you're talking about inventory. First, what we've seen being very important is how many stock keeping units a company has and what is their range of unit cost. An SKU is a distinct type of item for sale, such as a product from a company. Because most companies offer a range of products, they usually have a variety of distinct items for sale. Because of this, it's important to have a strong inventory management system to determine whether a company has too many products out there and if this might be thinning out their efforts, ultimately eroding their bottom line. Consider a plastics company, for example. They can have an SKU for every different piece of plastic they manufacture that serves a different purpose. If management doesn't understand each one, how profitable or what the margin is on each, or how the supply and demand is changing for each one, there may be money left on the table if they're not siloing their efforts correctly. That's why there needs to be a good focus based on your company's resources on the stock keeping units and making sure you're controlling the amount of those as well as the range of unit of cost. And so next we have concentrations. Same concept as with AR. This is very important to understand if there's any concentrations in the chain between raw materials all the way to finished goods. Understanding where significant concentrations lie there helps us ask good questions. Moving on, are there any special storage requirements? Understanding a company's inventory management system and being able to tie it to the balance sheet is important. Things such as cold storage or special storing conditions can be costly, can be burdensome if conversion of inventory slows down past what was expected and allocated for. And lastly, we have percentage drop shipped to customer. Is this percentage too high? What are risks associated with this percentage? And so with that, even though there's more examples, that covers the cash conversion cycle from inventory to AR to collecting that and converting it to cash. So to keep things rolling, let's move on to the last slide before we switch directions and topics. So I don't feel that I need to spend too much time on this one because it has a lot of the same concepts and thoughts as the previous two, just on the liability side. So this primarily deals with company suppliers and understanding each of those variables. If you remember from our AR concentration example of AR being spread too thin, the reason that became an issue is because the supplier stopped their relationship with, our borrower. They were a certified vendor of that supplier, and once the supplier took that certification away, things went south quickly. So managing AP goes hand in hand with managing AR and inventory. So every time you're looking at an AR aging, you need to be tying it with the AP picture just so you can understand it better holistically. The key to understanding the whole picture just lies in a few of these items below, which are pretty self-explanatory. And so with that, I want to turn it over to Nathan, who will cover the next section on our agenda, working capital.
Yeah, our next topic here is net working capital. So what is working capital? Well, it's the primary measure of a company's liquidity. It's defined as the difference between a company's current assets like cash, accounts receivable, and inventory, and its current liabilities, for example, accounts payable. But why is net working capital important? Well, it helps banks understand the company's operational efficiency and short-term financial health. Healthy working capital leads to companies' ability to invest and grow, and also with understanding solvency, the possession of assets in excess of liabilities or the ability to pay one's debts. So working capital is used to measure the short-term liquidity of a business and can also be used to obtain a general impression of the ability of company management to utilize assets in an efficient manner. If the net working capital figure is substantially positive, it indicates that the short-term funds available from current assets are more than adequate to cover their current liabilities as they come due for payment. If the net working capital figure is substantially negative, then the business may not have sufficient funds available to pay for its current liabilities and may be in danger of heading towards bankruptcy. The net working capital figure is more informative when tracked on a trend line, since this may show gradual improvement or decline in the net amount of working capital over time. Net working capital can also be used to estimate the ability of a company to grow quickly. If it has substantial cash reserves, it may have enough cash to rapidly scale up the business. Conversely, a tight working capital situation makes it quite unlikely that a business has the financial means to accelerate its rate of growth. A more specific indicator of the ability to grow is when accounts receivable payment terms are shorter than the account payable terms, which means that the company can collect cash from its customers before it needs to pay its suppliers. Here are some different ways that companies can improve their working capital situations. One method is requiring customers to pay within a shorter period of time. Of note, this can be difficult when customers are large and powerful. A second method is being more active in collecting outstanding accounts receivable, though there is risk of annoying your customers. Third method is engaging in just-time inventory purchases to reduce the inventory investment, though this can potentially increase delivery costs. The fourth method is returning unused inventory to suppliers in exchange for a restocking fee. A fifth method could be extending the number of days before accounts payable are paid, though this will possibly likely annoy your suppliers. In the commercial banking industry, when you have a relationship with a business customer, you're not only analyzing their current financial position, but you're also heavily focused on the trajectory of the business. In order to provide the most value to our customers and safeguard the bank against risk, we analyze working capital positions on three different approaches. First is baseline. The baseline analysis is their current financial position based on historical financial results and standing. This paints a picture of what their current existing working capital needs are. The second is pro forma. The pro forma analysis is essentially projections and a forecast of what their working capital situation will look like if their goals pan out as intended. The third approach is stress test. The stress test incorporates the pro forma projections at their most stressed levels. For example, during times of the year when it takes a company its longest time to collect on receivables or turn over inventory. There are many variables that affect a company's required working capital situation. These can include a company's revenue growth, changes in requirements of minimal amount of cash on hand, changes in accounts receivable days on hand, inventory days on hand, accounts payable days on hand, a company's debt obligation payments with current portion of long-term debt. Planning for events and activities is really crucial in maintaining a strong working capital position. It's definitely worthwhile to allocate a focus on anticipating upcoming events that will affect your working capital. For example, it's common for owners to take distributions in the form of cash to pay for taxes. Owners will pull from their cash account, which depletes their liquidity and working capital situation. Another example is if a company makes a large payment towards long-term debt or even pays it completely off in advance. This activity will alter the working capital position. Some loan structures do not implement prepayment penalties. In this instance, the customer may want to pay off their loan in advance so that they are saving money in the long term by avoiding interest payments. But at the same time, by doing this, in the short term, their working capital is taking a hit. Another event that changes working capital situation is investments in subsidiaries or affiliates. A prime example is when one of our customers has a related entity that is new and young. Our customer will provide its capital to the related entity to help support its operations until it can be profitable and begin repayment. However, in several cases, the related entity never gets successful to the point of being able to repay our customer, and ultimately the customer will bleed itself dry from a working capital position. Structuring loans to supplement working capital. The most common solution for companies seeking working capital assistance from banks is revolving lines of credits. We refer to these as RLOCs, which help bridge the gap with collecting on receivables and fund short-term financing needs like purchasing inventory or paying vendors. Lines of credit are established as a supplement to working capital, not as a replacement. RLOCs operate kind of similar to what of a large credit card. The customer can make an advance on the line and draw cash from the instrument. RLOCs are intended to resemble a healthy heartbeat, with a continuous cycle of advancing on the line, collecting receivables, and then paying down the line. There is a term called evergreen line. Evergreen lines are what banks do not like to see from the customer's utilization. This resembles a flat line dead heartbeat. Basically, the customer has advanced on the line, but is not making any pay downs. This naturally brings into question of risk. Why is the customer not paying down the balance? Is it because they are unable to pay it down? This usually leads to discussions with the customer to understand their circumstance and situation. Potentially, the credit may not be renewed and the outstanding balance gets placed on a term loan for a workout situation. What is a borrowing base? Well, it's the maximum amount of money a lender will loan your company based on the value of your business assets. The amount of collateral you offer in order to secure the loan influences just how much a lender is willing to commit to you. Essentially, the borrowing base is how much money your business can actually borrow if and when it needs to. For small line of credit loans for working capital purposes, borrowing bases generally aren't implemented in the structure. We typically see borrowing bases on large line of credits due to the risk involved. Having a borrowing base is a good control or governing mechanism to make sure the borrower has enough collateral for their credit needs at that specific moment in time. Borrowing bases are usually structured with assets for collateral, including accounts receivable and/or inventory. The bank will provide borrowing base certificates, which is a form that the customers will then input and fill out. This depicts the current value of their assets to show that they have enough collateral coverage for the financing. Why are borrowing bases dominated by inventory risky for banks? Well, inventory by nature is speculative of sales occurring. Conversely, accounts receivable reflect sales that have already occurred. They're just in the process of collecting the payment. If a customer defaults on a loan, the bank may need to sell the inventory at a discounted rate or a fire sale, which are never fun. Now we'll cover our baseline working capital. The model shown above is what we call a working capital model. This basically is a program or instrument that our commercial lenders and credit analysts use. The model is very helpful with trying to analyze and assess a business' current and future working capital needs. Very few businesses can operate with a negative working capital position. So with our bank having a predictive model like this, it's really impactful that we can try to anticipate what their working capital situation will look like so that we can structure solutions before challenges or problems occur. The analysis that we are viewing above is from a baseline working capital approach. This utilizes a company's historical financial information to understand their current working capital needs. Baseline essentially means current conditions. The baseline model incorporates many different variables, including their sales, cost of goods sold, accounts receivable days on hand, inventory days on hand, accounts payable days on hand, their line of credit structure, financial covenant requirements, and other variables. Once we have the inputs in place, our model will generate the baseline for their current working capital picture. Based on this baseline approach for working capital purposes, this business needs a minimum RLOC commitment of $609,000 for its operations. Moving on to our next phase of predictive modeling, the image above is a more advanced iteration of our working capital model. This incorporates the baseline approach that we just examined, as well as the pro forma and stress case approach. The extra components allow us to project what their future working capital needs will be based on the company target goals and historically stressed data. If a company is in the business of selling swimming pools, their working capital needs in the summertime are going to be different than they are during the wintertime. So with the bank being able to analyze pro forma projections and stress data, this helps us paint the picture and provide a line of credit amount sufficient for their needs when they're at their max capacity. On the left side, you'll see the baseline inputs. Next to it, you'll see the pro forma projection inputs and stress data. In this example, the company will need an RLOC commitment of $1.6 million to hit their pro forma projections. Under the stress case, the company will need an RLOC commitment of $2.2 million to hit their pro forma projections while experiencing max capacity conditions. To wrap up this segment, in summary, we are using working capital models based off historical financial information and plug in projections to better understand what their current needs are and forecasted needs will be.
All right, so moving on from the working capital. What I want to talk about next is arguably one of the most important aspects of the balance sheet. We're talking about leverage. So how are we defining leverage? Leverage is defined as the use of debt or borrowed funds to amplify returns from an investment, project, or asset. Examples Nathan and I see daily are businesses that are wanting to expand, so they borrow senior debt from Frost to fund new assets such as a new building, new piece of revenue generating equipment, or other fixed assets. From the bank's perspective, leverage is key to understanding the health of a company's balance sheet. So real quick, a few mathematical formulas can get you started in that process. First, and a lot of times most important, is debt to tangible net worth. This ratio indicates the level of a creditor's protection in case of the firm's insolvency by comparing total liabilities with net worth. Tangible net worth is most commonly a calculation of net worth of a company that excludes any value derived from intangible assets, such as copyrights, patents, and intellectual property. This is calculated as just total assets minus liabilities, less intangible assets. So the main drawback of this formula is when a company does have significant intangible assets, but that is not the case for a lot of the companies we're working with. Second, we have the debt to equity formula. This gives you an idea of how much of an organization's funding comes in through the form of debt versus equity. It's a general observation. Debt is a cheaper form of capital than equity, and the cheapest form of debt comes from bank institutions such as Frost, who are senior credit lenders. So this gives you an idea of the picture of how a company is being funded, debt versus equity. Third, total liabilities to equity used in conjunction with the debt to equity ratio to determine the impact that operational liabilities has on the funding of the business. And lastly, we just have total assets to equity. This is a very simple ratio, which can help you determine just from a high level whether your company is under leveraged or over leveraged. So these four ratios will get you well on your way to understanding your current leverage position. And so now that we understand how to get there from, a formulaic perspective, let's talk about the bigger question. Why is managing leverage so important? So as a bank, this is time and time again one of the biggest pitfalls we see businesses run into. We've seen a lot of great companies in some really tough times because they didn't have a great grip and understanding of their current leverage position. Entities will end up leveraged due to a number of reasons, some positive, some negative. The first one being a negative reason, financial deterioration over time. Negative financial trends leads to this type of leverage as assets are shrinking at a much faster rate than the debt and their leverage ratios start to balloon. Number two, additional debt. Generally, this type of leverage is the result of positive financial trends and growth. The additional debt is anticipated to create opportunities for the entity. Debt is a great tool for growing your company, but only when utilized properly. So it's important to keep a good grip on how your company is trending. The companies who can forecast their trends the most accurately have a good chance of maintaining their leverage to equity levels properly. And lastly, although I won't touch on it much, it's important to note leverage buyouts, aka mergers and acquisitions or M&A, and decapitalizations. These can be a good reason for increased leverage ratios, but we'll not be touching much on them today. So, and as a result of these three different events that result in higher leverage, Companies typically will have a diminished ability to adjust to unexpected events and change in business conditions because of their higher ratio of leverage compared to capital and cash flow. This excessive leverage can diminish the borrower's and the bank's ability to react ultimately, jeopardizing loan repayment, causing defaults and other issues. So how do we help both our customers and help protect the bank by avoiding these excessive leverage scenarios? We do this by starting to have the conversation with business owners early and often, and letting our customers know if they fall into either of these two categories we're going to go into in this next slide. So with these two categorizations, you have companies with excessive leverage in relation to their industry, which we define as those who possess the following criteria. Balance sheet leverage, we're using the debt to tangible net worth ratio of over 3 to 1. This 3 to 1 debt to tangible net worth figure is a general rule of thumb. Of course, this is dependent on the customer's industries, and some have higher leverage on average. For example, if you're thinking about transportation, technology, healthcare, they might have higher tolerances for debt because it's crucial in their industry. The flip side, you don't see as much debt in other industries that aren't as capital intensive. So that's how we define companies based on that ratio who may have excessive leverage, but there needs to be more of a conversation on that. So the second category we look at when looking at leverage is whether it falls under a highly leveraged transaction classification. So these are transactions defined to the bank to be potentially risky due to a few different reasons. First being high direct exposure of debt. We like to set that bar at about 5 million. If the company has that much exposure of debt or more, then it's very important to understand have the right conversation surrounding leverage to make sure it's in a right position. Two, the ratio from before, just making sure the balance sheet ratio isn't above 3, depending on industry. And lastly, if either of these following situations occur. So whether on a trailing 12-month with senior debt or a trailing 12-month with total debt, just making sure those fall right in line with the ratios. Because if it meets those 3 conditions, it gets flagged from a regulatory perspective. That's a highly leveraged transaction, which in this case means more risky. So in conclusion of the leverage section, I know there was a lot thrown out there, but the key takeaways are that leverage is a double-edged sword. It can be both very good, but also very bad. More debt for a company that already has high leverage could make sense in certain instances, just like it might make sense that a company is under leveraged for a time as things are uncertain and economies are uncertain. But because of this trade-off, you want to make sure that you're in control of your leverage. A few and good practical ways to do this is by having appropriate conversations early and often. It also helps to have more than just your management's eyes on your financials. So having that good banking partner that can help monitor those leverage trends as well can really help you out in the long run. And then just having experience in the industry and being able to understand the overall financial performance picture of your business. And lastly, being able to adequately model and forecast financial performance. There's some events such as what we're all going through right now that you can't control, but you can control taking on more debt in years where your industry is declining or companies' expected results are dipping. A good website we like to use for finding good comparable industry data is rmau.org, and this can help you kind of track your trends compared to the rest of the industry. And lastly, I want to just provide you with some quick insight on how banks will be looking at companies who fall into this excessive leverage category. Banks will be looking for highly leveraged companies to possess historical ability to service the resulting indebtedness with acceptable coverage. A good rule of thumb is cash flow coverage of 1.25. And also we're looking at companies who demonstrate the ability to repay senior term debt and 50% of their debt throughout 5 to 7 years. In the event a portion of the debt structure includes a revolving line of credit, the amortization of this debt is not included. The second thing, we're looking for highly leveraged companies to possess a strong, viable secondary source of repayment. This may be a guarantor's liquidity, sale of assets, or another form of repayment. So with that, I'm going to turn it over to Nathan to cover our last topic, retained earnings.
Thanks, Harrison. The next critical segment of the balance sheet management is retained earnings. As a refresher, retained earnings are the profits that a company has earned to date, less any dividends or other distributions paid to investors. The formula for ending retained earnings is beginning retained earnings plus profits or losses less dividends equals ending retained earnings. Owner's equity can be distributed in 3 sections of the balance sheet: in current assets, net fixed assets, and other long-term assets. This also works closely with working capital. Now, why is retained earnings important? A large retained earnings balance implies a financially healthy organization. A company that has experienced more losses than gains to date, or which has distributed more dividends than it had in the retained earnings balance, will have a negative balance in the retained earnings account. This is called an accumulated deficit. A growing company normally avoids dividend payments so that it can use its retained earnings to fund additional growth of the business in such areas as working capital. The company may also elect to use retained earnings to pay off debt, rather than make any distributions or pay dividends. Another possibility is that retained earnings be held in cash reserves in expectation of future losses. As a company reaches maturity and its growth slows, it typically has less need for its retained earnings, and so is more inclined to distribute some portion of it to its investors in the form of dividends. Considerations for retained earnings. Age of the business. An older company will have had more time in which to compile more retained earnings. There's also dividend policy. A company that routinely makes distributions or issues dividends will have fewer retained earnings. Profitability. A high profit percentage eventually yields a large amount of retained earnings. The more profitable the company operations are, they're boosting their equity position. Cyclical industry. When a business is in an industry that is highly cyclical, management may need to build up large retained earning reserves during the profitable part of their cycle in order to protect it during downturns. The decision to retain the earnings or to distribute it among the shareholders is usually left to the company's management. The management decision leaves a huge impression on their bank. Are they focused on reinvesting their profits back into the company to support growth and strengthen their financial position? Is it a blend of balancing their profits to support company growth and making their shareholders wealthy? Or in some cases, is management draining the company's equity to make themselves rich? This discussion between the bank and customer can go a number of different ways. Depending upon the situation, it might even potentially lead to having covenants on distribution limits to ensure that the company can adequately sustain its own growth. With that being said, in general, for commercial banking, we like to see company reinvesting the majority of their profits year over year back into the company to support its own growth. Businesses with the goal and determination of increasing the retained earnings balance each and every year is a sign of a healthy organization and a good trajectory of the business. To end our discussion today, here are key takeaways from Frost Commercial Bankers. Liquidity. As we've all learned and experienced, you never know when an emergency or pandemic can hit. At the bare minimum, try to have a rainy day fund of liquidity to help keep the doors open and operations running. If you're looking for a numerical ratio goal to reach and maintain, for current ratio and quick ratio, 2 times and above is a good target. Trading assets and inventory management, invest in good inventory management systems. Make sure your warehouse or storage facility is in good shape. Marketability is very key. What happens if you stockpile on goods that are difficult to sell and turn over? Fire sales are never fun. Now, as it relates to accounts receivable, what benefit does it bring to you if receivable balance is growing out of control and you're not collecting on it? Factoring or selling it to collection agencies or even write-offs, it doesn't do any good. Make sure you have good invoicing and collection processes in place with a dedicated team and oversight. Working capital. If you have negative working capital, it means you can't pay your debts and obligations through ordinary business operations. Revolving lines of credits from banks for working capital is not a replacement, it's a supplement. So try your best to continuously improve on collecting payments from customers quicker Manage your inventory levels and inventory days on hand, and take advantage of terms with your vendors and suppliers. Leverage. Don't bite off more than you can chew. In many cases, it's more important to focus on improving operational efficiencies and profitability rather than thinking more financing is going to cure everything. If you do take on debt or financing, it's best if the company is getting tangible assets to own in the process. This helps offset the leverage. If you're looking for a numerical ratio goal to reach and maintain, for debt to tangible net worth, a ratio of below 3 times is a good target. Retained earnings. Businesses with a goal and determination of increasing their retained earnings balance each and every year is a sign of a healthy organization and good trajectory of the business. To conclude, if it's your business or someone in your network, if you're looking to strengthen your balance sheet to become more bankable from a commercial lending perspective, please give us a call. You have our contact information. We'd love to talk with you. Also, if you have a line of credit or exploring into line of credits and looking at different ways of structuring them or different amounts that might make sense for your business, or funding from an amount that's going to help your business grow with whatever your projections or target goals are. Also, please give us a call. We're here to help, and our focus is to help make people's lives better. Whether or not you bank here with Frost Bank or at any other bank, we'd love to help.
Yeah, and ultimately, as Nathan's saying, we're just here to help. We hope that we know there was a lot of information in that presentation today. So just let us know your thoughts. Let us know what questions you have, and we hope that everyone got something beneficial out of this presentation today. So let us know.
Thank you.
Thank you.
Thank you for attending our webinar, and thank you to Frost Bank for that amazing presentation. If you have any questions for one of our LGT professionals or would like to know more about our events, please contact us at askus@lgt-cpa.com, and don't forget to follow us on social media. Thank you again for joining us, and have a great day.